Got your eyes on a home? You'll need the local home loan experts at Guaranteed Rate Affinity. We are a fintech mortgage company that streamlined the home buying process. Our loan officers have direct access to the best real estate agents, giving you a completely seamless home buying experience. Featuring the industry's most advanced tech platform and customized loan solutions, our local loan officers can help you at any time from anywhere. Our digital mortgage and power bid approval will get you pre-approved in minutes with a strong offer even against all cash offers. You need speed to win in this market, and our same-day mortgage delivers, getting you approved in as little as 1 day. Getting you on track for the closing table in as fast as 10 days. Speaking of the closing table, our flash close options shorten the closing appointment from hours to minutes, or skip it altogether. It's your choice. We've made the home buying experience as fast, simple, and awesome as possible for countless others, and we'd love to help you next. Get pre-approved today with the experts at Guaranteed Rate Affinity, and let's get you home.
All right, good afternoon, everyone. It is a pleasure to be on with you. Today is a really interesting day in the market, and obviously we are doing this call purposely post-election. First off, I'll give you a couple of introductions here. My name is Frank Chardelli. I'm the Senior Vice President of Sales for Guaranteed Rate Affinity. We are a sister company to Rate Inc., and many of you know Guaranteed Rate. Guaranteed Rate Affinity is, like I said, just a sister company. And with us today is our Chief Capital Markets Officer, Jeremy Collett. And before we get to this, I really wanted to make sure that that everyone knew Guaranteed Rate Affinity. We have every single product that you can possibly think of to really help out all of your borrowers, help out yourselves, whether it be obviously the conforming loans, and we were just celebrating Veterans Day yesterday, and we have an amazing product line for veterans to take advantage of. And thank you to all of you that served or have someone in your family that is serving. Thank you very much. And we also have those, kind of outside of the box loans, what's called non-QM or non-qualified mortgages. So if you have a borrower that may be a little bit outside of the norms, our loan officers at Guaranteed Rate Affinity can really help you out. And then we also have some of those really specialty products called reverse mortgage for our borrowers that are at the back end of that, the third back end of their lives. And we really want to make sure that we can help out our seniors really have a very comfortable situation. So if you do know of anyone that needs some assistance with understanding a reverse mortgage, our loan officers at Guaranteed Rate Affinity can really help you out with that. And then we also have some of the amazing tech products with our HELOC and our closed-end second mortgages to help out you and your borrowers as well. But with that being said, really exciting. This is a very interesting period of time of history. And like I said, we have one of the best capital markets team literally in the entire country at Guaranteed Rate Companies, and really excited to have our very own Jeremy Collett as one of the top capital markets executives in the country to help us out, steer us through really complex situations here. And Jeremy, I appreciate you taking your time today. Really cool background there. You could tell that Jeremy is almost like in the Matrix. And for those of you, please ask questions. We want this to be a forum where we can do some Q&A. So if there's anything that sort of piques your interest or things that you'd like to know a little bit more about, please let us know. Just use the questions feature in the GoToWebinar, and we're going to spend some time doing some Q&A towards the back end as well. So Jeremy, thank you so much, and I'm sure you and your team have been really busy kind of digesting over the last week as to what might be happening in the rest of this year and then going into next.
Yeah, thanks, Frank. It's great to be here. Thanks for having me. Yeah, obviously the last week has been pretty tough. Just trying to unpack everything that's happened from a markets and economics perspective. So I'm going to go ahead and apologize out front because I don't want a bunch of folks coming after me with pitchforks and torches here. But the reality is the election, even leading up to the election and the results of the election, they're having a pretty substantial impact on the markets, specifically on the bond market, on housing. And I'm going to try to go through that today without ruffling any feathers. But, in order to get there, let's just kind of set the table. So I've divided this presentation into a couple different segments. First of all, let's start with the first section, which should be called the 2024 election, right? Just kind of rehash what happened. So, and I think in order to get to sort of the Biden administration and what happened economically, you got to take a look at what's happened since COVID, right? Because it's been such a generational market move. The pandemic obviously affected, so many people's lives in different ways, and had a really huge impact on the market, on home prices, on affordability, all the things that are important to voters and to market participants now. But, Frank, one of the things that I was just really surprised by was, if you look at sort of the polling data amongst voters, right? It's particularly the ones that leaned Trump during the election. Every one of them, either the number one or the number two issue for those voters that ultimately voted for Trump was the economy, right? And it just feels like, not to play Monday morning quarterback here, but I'm gonna play Monday morning quarterback. There wasn't enough emphasis on the impact of Biden economics. And what you'll see is, the strength of the consumer confidence, retail sales, GDP, the fight against inflation, even though prices are really high. And obviously we see that particularly evident in the housing market. The Biden administration actually has a pretty decent record on the economy. So, like I said, I don't know why that wasn't more of a fixture in their campaign, especially with someone with such notoriety, serving in the Biden administration, like Janet Yellen, who was Secretary of Treasury. That could have easily been a strength of the campaign, and it just wasn't for whatever reason. It wasn't talked about that much or marketed or anything. But let's just take a look, because it really sets the stage on what the Trump administration is going to inherit, and really drives forth what's going to happen in the markets, the financial markets. And a lot of that, the so-called Trump trades, already unfolding right now. But again, if you go back to the pandemic, I think everybody's well aware of what the Fed did, right? Back in 2020, the spring, they started cutting rates and effectively moved rates to zero, and then restarted quantitative easing, which means the Fed was, making liquidity for lending and business operations more available by giving out loans, supporting investment, and moving rates to zero, which just enabled companies and individuals to borrow money and invest in the economy. So as the country and the world even, had to face lockdowns and other things, that was really a key fixture in keeping the economy rolling. And nobody knows that better than folks in real estate and home finance and mortgages, et cetera, right? So what ultimately came out of that, right, is this spike in inflation that led to 40-year highs of inflation, price increases not seen since the Carter administration. And those, of course, were a direct result of this zero, super accommodative, zero interest rate policy by the Fed. But if you look at the PCE sort of annualized index, you saw inflation rates, spike up from around 2% pre-pandemic, which is also in line with the Fed's target of 2% inflation, all the way up to just under 6%. So the PCE is just one measure of inflation. It's a consumer, it looks at consumer spending, and it's run by the Bureau of Economic Analysis. But if you look at the Fed statements like last week when they, met and lowered interest rates by a quarter and gave forward-looking guidance, the PCE is what they look at. So you can see once that got up to 6%, 40-year highs in 2022, it was pretty evident that this just wasn't a transitory event. In other words, monetary policy had led to this spike in inflation, and it just wasn't the supply chain, or manufacturing disruption from COVID, right? So let's flip to the next slide. I think the next one, again, has been just such a part of the story leading up to the markets today. But CPI did something very similar. This is just a different index of inflation based off of consumer spending in urban areas. But again, this one also almost reached double digits, CPI at nearly 10% back in 2022. If you look at the right side of that, though, you can see inflation's really come down to more normalized sort of pre-COVID levels. Again, something that wasn't really talked about that much during the Harris campaign, and it kind of baffles my mind. Let's move to the next slide. This is really just a collection of slides. I want everybody to get the sense of what markets are doing, what key economic indicators have been driving behavior of investors and consumers. Frank, are you still there? Can you hear me?
Yep, I got you. I think we lost your video, but we still,
I think the internet's just calibrating. Sorry about that. So here is the Fed funds rate, right? So we were riding around 0 to 25 basis points or 0.25%. They kind of hold this target when they set monetary policy. But you can see, after that run up in inflation in 2022, the Fed starts to hike rates to get in front of runaway price growth. Many say is, too little too late by that point. The Fed held rates at 0 for too long. By this point, this was a couple years ago, so kind of ancient history at this point. But regardless, you can see how the Fed reacted to high inflation rates by, raising rates and trying to stifle consumer behavior, spending, lending, that sort of things. And, for the most part, it's worked. Let's go next slide. So you could say effectively raising rates from 0% all the way to 5.5%, which is what the Fed did, put a lot of risk to the economy, right? Like you get that kind of increase in rates, mortgage rates went from the high 2s, say 2 3/4, all the way into the mid 7s. I think real estate obviously slowed down. Refinancing activity essentially disappeared. You go back a couple years, and most economists were predicting some sort of drastic economic slowdown. The recession word at the end of I guess at the start of Q3 in 2023 was being thrown around, and ultimately that led to an inverted yield curve. So an inverted yield curve simply means that shorter term interest rates are higher than longer term interest rates. So if you think about what an investor in loans or bonds or securities actually does, you think about what's on a bank's balance sheet. They give out loans and make loans or buy loans closely tied to the longer end of the curve. So call it that 10 to 15-year tenure down on the bottom. You can see that on the axis. And around there, and I just went back and kind of took a snapshot from early 2023, you can see the rates were right around 4%. But if you look forward, if you look left on the yield curve, shorter term rates, so that would be rates from 1 month to 1 year. So this is a bank like taking on liabilities and borrowing money. Banks are paying much more for deposits. Investors are being charged a lot more for financing that's closely tied to like 1 month rates and 1 year rates. So already, if you're paying more to borrow money to invest in assets that have a lower interest rate, you're basically losing money. And in the trader world, that's called negative carry. That's generally a sign of really bad things to come. And the next slide, I'm sure most people have heard of this or seen some version of this slide, but there is this correlation towards yield curve inversion ultimately signaling a forthcoming recession, right? So you go back to Alan Greenspan's period of chairman of the Fed back in the early 2000s. We had yield curve inversion in 2001, which ultimately led to a recession. Same thing during the financial crisis. As the Fed started, coming out of that, you had yield curve inversion in probably 2007, 8, right around there, which ultimately led to a recession. So the inverted yield curve that we saw at the beginning of 2023, that was persistent all the way till, parts of it are still inverted, but even most recently, the curve is just starting to steepen out a little bit. The Biden administration effectively navigated the economy through that without sending the economy into a recession, which is pretty remarkable considering over the last 60 or 80 years, every yield curve inversion has led to a recession. So again, I'm still left kind of scratching my head wondering why that wasn't more of a focal point of the election, because by most measures, the economy is performing really well right now. Let's look at the next slide. Yeah, great. So this is, again, when we look at how is the economy performing, these are the main things that folks talk about, right? So if you go back to this chart right here is the unemployment rate. And part of the Fed's dual mandate is to do two things. One, price stability, manage inflation. Their target's around 2%. You'll see where that's going. The other part of the dual mandate of the Fed is to ensure that the economy is operating at full employment. So during COVID, for example, the unemployment rate was, right at 15%. You see it spike there in spring of 2020. Obviously, over the last few years, the unemployment rate has been normalized back down to a really healthy 4.1%. So the unemployment rate looks great. Employment, by that measure, firing on all cylinders. If you go to the next slide, you also see, and I think this is the labor force participation rate. This is just a measure of, hey, what's the percentage of our population engaged in the workforce, right? So during the previous administration, it was around 63% and obviously dipped way down to right above 60% during the pandemic. But you can see it's recovered nicely back to 62.6 to 63. So labor force participation rate has been on a steady incline, which is great for the economy. The unemployment rate hovering around 4%. The employment market looks really good. Let's click to the next slide. So this is GDP, right? Another, just really important economic indicator, not necessarily part of the Fed's dual mandate, but a GDP under 0 represents economy in recession. And I think it has to have 2 straight quarters of negative GDP growth. But you can see, obviously, we got this giant pop from the Fed's really, promotional monetary policy when rates were 0 and they were buying mortgage-backed securities and buying treasuries. Our GDP spiked way up to 16%. But even today, even though it's kind of normalized, it's still hovering right around 5%, which is a massive number. So economic productivity's remained really strong. Next slide. Yeah, so just to wrap that up, just based off of the economy alone, considering coming out of the pandemic and off of this 40-year high of inflation, both important inflation measures are basically drawing back to the 2% rate, which is the Fed's mandate. The employment market remains super strong. And then other measures like retail sales, ISM manufacturing, GDP, which I showed, have all been really strong. So it does feel to me a little bit like the Harris administration sort of shot themselves in the foot on not being able to cover the economic progress that occurred under the Biden administration. What I will say, though, is where I think the Biden administration really struggles was with housing affordability, right? So I think the general consensus is affordability is probably at the worst it's been in forever. And I've always likened that to what happened during the financial crisis, right? Like most home builders had a really hard time sourcing liquidity, sourcing financing, and got hung with a lot of unsaleable inventory after the great financial crisis. So that, to me, that led to like a 10-year lull of home building. And obviously you saw that constrained supply really kind of rear its head during the last 4 years, especially when rates were ultra low over the pandemic. But then you combine that with rates going, the Fed hiked rates 11 times over the last 4 years, and all of a sudden you get pressure on the payment side from higher interest costs, and then this sort of chronic supply issue that has been plaguing the market for a long time. So when the two candidates, and I'll go into more of this later, but the counties that suffered the most with affordability were the ones that had the biggest shift from voting Democrat to Republican during the last election, which is a pretty telling story. So all the other economic indicators aside, housing and housing affordability continues to be a major issue for voters, especially swing voters that could go either way. The plans with housing were also very different, right? I think the Harris administration, their plan on housing was centered around more federal down payment assistance programs, which, if you think about it, doesn't make a lot of sense in addressing the supply problem, because at the end of the day, we're probably short about 5 million homes to kind of quelch demand in the country. And then the Trump policy, looking forward, was to increase housing supply through allocating federal lands for home building, new construction, and then also deregulation. And that's a theme in a lot of the markets that we'll be talking about today. But at the end of the day, I think that was more appealing to swing voters, and here we go. So let's move to the next section.
Hey, Jeremy, I got a quick question for you.
Sure.
So the Biden-Harris administration implemented LLPAs, loan level price adjustments. That was one of their regulations that they put in there. And, I hear, kind of anecdotal evidence that was one of the big reasons why, home affordability became an issue. Obviously, the lack of units on the market and builders getting into it. But for those that may not know about what loan level price adjustments mean, would you mind just giving a little bit of insight as to what that is, and maybe if the Trump administration would be deregulating that or keeping that?
Yeah. So I actually have a whole section about the GSEs and the differences between the Trump, let's call it the 1.0 administration, what happened during the Biden administration, and what's likely to happen over the next few years with the GSEs, because, to me, that's a big topic. I just don't know if it's a big topic and a big agenda item for the Trump administration. So there's quite a bit of uncertainty about that. But I'm going to go over that in more detail later in the presentation. But yeah, for right now, the LLPAs, so when we pool loans here and we sell them to Fannie and Freddie, there's a whole kind of grid of pricing adjustments, and they're based off things like LTV, occupancy type, credit score, all these things that are associated with risk, right? So obviously a higher LTV has more risk of default, so there's a higher loan pricing adjustment. And then a loan with a higher credit score, maybe, and a lower LTV, there's maybe less risk associated there. So what happened a couple years ago with Fannie and Freddie and their regulator, the FHFA, they basically reduced the spread between what would be perceived as higher credit risk loans and lower credit risk loans. So yeah, there is this idea that, and I'm not going to talk for days about this, so I don't want to get off on a tangent, but yeah, there's this idea that the GSE have been worsening interest rates on borrowers, and I've got a slide later where I'll show you what I'm talking about. But yeah, there's definitely some big time changes to pricing adjustments that changed affordability from that perspective as well. So the Trump trade, right? The Trump trade 2.0, it is on right now, and it's all risk on. And what that means is, the sort of idea that deregulation and tax cuts are going to lead to more earnings. They're going to lead to bigger gains in productivity and business output, is leading to this stock market, and affects some other things that we'll get into. But yeah, let's move ahead. I think the next slide is just a recap of what I just said. Yeah, so deregulation, considerable tax reductions. One of the things on the tax side is, there's really two things that I think are really important. With the Trump win, we basically forego the potential of $3 trillion of new corporate tax increases under a potential Harris administration, right? So obviously corporate taxes go right into earnings and dividends. So you're seeing a massive, kind of unwinding of that fear, among equity investors right now. That means companies are going to be paying less taxes, and they'll have the ability to dividend more of that out to shareholders, right? Deregulation, the same thing. I was reading, something about, and I think it was Forbes yesterday, just about the expense and cost of home builders dealing with regulatory costs right now. And it's something like 24% of the cost of a new home, which is a quarter. I mean, that is just mind blowing. And I live in Florida part of the time on the coast, so I'm pretty happy that my home's built up to code and all that stuff. But yeah, almost 25% of the cost of a new home is wrapped up in deregulations or in regulations. So obviously that isn't, that's not helpful for home affordability. And then,
Jeremy,
yeah.
Do you know, what would that be compared to the last or the first Trump administration? I mean, is that something that is normally tracked? But 25% seems absolutely astounding.
Yeah. No, I actually don't know the answer to that. But we can dig into it and see if we can find something. Some of those numbers are really hard to find. I mean, you kind of got to dig through financials and reports and filings with the county and builder permits and all that stuff. You know what I mean? But I feel like we've got a decent source, so we can try to figure that out. But yeah, let's flip forward, because I'm going to talk about those other two things as we get going. But I think the market started to take seriously a Trump victory, right around the time the Fed made their first rate cut in September. So that's when we sort of see this emergence of the Trump trade. And this is what I'd call, I think folks have indicated that the Polymarket election poll was pretty accurate this time around. And you can see the odds, just over 50%, I think is tilting towards a Trump victory. But that started around late September. It was kind of hovering around 50-50 for most of September when the Fed made its first rate cut. But obviously over October, you started to see the odds of a Trump victory really start to gain some momentum. And we could skip to the next slide. You see that, filtering down into a lot of the markets as well, especially interest rates. So this is a chart of the 10-year yield, and you can see since that rate cut, and I got so many questions about this. If the Fed's cutting, why are rates going to the moon right now? And we essentially saw yields go from about 360 to 440, so about 80 basis points higher on the 10-year Treasury yield. We had like some uptick in inflation and CPI, like a small uptick in wages in September and October that are accountable for some of this. But a lot of this is two things, right? The Trump trade and how that is impacting the risk on trade, meaning investors are basically pulling money out of the bond market, selling bonds and shifting in them to higher returning, riskier assets like stocks and Bitcoin and things like that. So you started to see that really pick up speed around mid-September. And then let's skip to the next slide. Yeah, this is a slide, and I know it's busy, but just bear with me, because around that question about, well, the Fed just cut rates, why are rates going up? This is a slide that I just kind of built. I built a custom chart on Bloomberg. That's the application for the most part I've got on my screens back there. So sorry for not putting this all into a guaranteed rate affinity format and all that. It's just easy for me to grab quick snippets from my machine in the back. But when you're looking at rates and thinking about markets and even looking at them today, right, like intraday, you got to remember that markets are always working on what they expect to happen in the future, meaning the inflation numbers, the employment numbers, things that are printing today aren't as relevant as what the forward view is, right? Because if you're waiting on this stuff to print before you reprice markets, like you're already too late, right? And I'm sure there's a fair amount, and I wouldn't call it speculation, but just a forward view on what home prices are going to do for everyone that's purchasing a home too, right? Like you're looking at the listing price for sure, but you're also looking at the set of economic events and markets, and they're telling you what's going to happen with inflation. So you make this investment, the appreciation is going to earn you money in the future, right? So that's kind of what this chart lays out. So I would say to the people that are like, well, the Fed just cut rates, and you can see that on this sort of bar chart at the bottom. I think it's yellow. I'm a little colorblind, but yeah, the yellow orangey one, that is the expected Fed rate down there. And you can see that it fell from 5 to around 450 from the middle of the summer, right? And that's when inflation really started to come down. There were some hiccups in payroll data that came out, and it looked like the Fed basically had like a clear runway to start cutting rates. So at the same time, you saw interest rates on mortgages. So up top, you've got conforming and jumbo 30-year mortgage rates, and you can see them fall by about 50 basis points during the same time period. So from about mid-summer to the first rate cut in September. The 10-year Treasury does just about the same thing, moving from about 4 to 410 down into the 350s, 360, right around there. So even though the Fed cut didn't happen until September, you can see those things in other, loan markets and bond markets start to price them in much further in advance, and they correlate nicely to what the market's view on Fed futures, what the Fed was going to do in September, right? So I don't know, hopefully that makes sense, but we're always pricing in with a forward-looking view on what we expect to happen and what the markets expect to happen.
I think that's been one of the biggest challenges with trying to figure out to most people, why exactly the rates have actually increased as opposed to going down. And I think that's probably one of the best explanations that anyone's heard. So hopefully that makes some sense. And again, everyone listening in, if you do have some questions or like some follow-up on something that Jeremy's saying, just please put that in the the question feature, and we'll happy to do some Q&A towards the end.
Yeah. And so this market's been really interesting. And unfortunately, I'm just a watcher now. I used to trade a little bit of Bitcoin. But when the housing and mortgage market basically entered like a recession like period, my view was, you know what, Jeremy, you need to focus on your day job and not take the risk in the Bitcoin market. Unfortunately, I was totally wrong. And over the past, call it 2 to 3 months, and all this stuff syncs up, like I said, with Trump's momentum coming into election day as well, right? Which is why you're seeing this run up in interest rates. It's why you're seeing this run up in the stock market. Deregulation, tax cuts also fueling that. But you also have got, a president-elect who's very favorable on Bitcoin and cryptocurrencies, right? So I think you're going to see, the use cases really increase under the Trump administration. You're going to see, perhaps some deregulation in Bitcoin, making it more available, for use and all that. So we've seen, basically like a 40% increase in the price of a Bitcoin over the past 8 weeks or so, which is pretty remarkable. So where's that money coming from? It's coming out of the bond market. On that side, there's more sellers than buyers, and that's pushing interest rates up and going into more risk. And that's why we call this the risk on trade, because risk is on. Let's see, let's go to the next slide. S&P, like I said, stocks continue to rally. This has been, the election results have been very positive for equities. What's next? Yeah, no surprise here, right? Defense and aerospace stocks have been rallying. This is an ETF that's just comprised of different stocks in the defense sector. They've been very bullish since the election results came out, and even before that, you can see going back to September. Next. And crude oil, right? Like, I don't think that's a surprise. The American, oil, fossil fuels, crude oil, natural gas, that industry is going to be open back up. There's likely a lot of growth potential there that's disinflationary, by the way. So you've seen crude oil, despite all the geopolitical tensions in the Middle East, drop from about $84 a barrel to 68. So that's pretty substantial. Next. All right, so if you work at GRA, this is a chart that I send out all the time, and there's probably a lot of questions around this, but when it comes to the talking heads on TV, is the Fed going to cut a 1/4 point or a 1/2 point or not cut at all? The markets pretty much are already telling you what's going to happen. So what this is right downtown here in Chicago, Fed futures trade on the market. They used to trade down in the pits. Of course, now it's all electronic, but these futures contracts basically tell you what the market thinks about future Fed cuts, right? So the implied rate cut change for December right now is just down to about 13 basis points. Can you see that where it says implied rate change for the December meeting that's going to be, on December 18, 2024? This a couple months ago was down 50 basis points. So if you extrapolate that out and look at the next year, just about 2 weeks ago, we were pricing in, and I mean we as in the markets, about a point drop in the Fed funds rate in 2025. That's down to, if you go from, let's see, 4.4 to the end of next year, 3.8. right? So that's down to just 50 basis points now. So one of the things, and this isn't good news, I'm sorry, but this is what the market's kind of forecasting here. Yeah, we're kind of at even odds for a rate cut next month. I think they go ahead and cut anyway, a 1/4. Jay Powell's kind of at least seemed committed to that, and he usually doesn't really fall back on what he's telegraphing to the market. But instead of the 100 basis points of rate cuts next year, it's looking more like a 50 to 75 basis point cut right now. And every day the odds keep falling, as Bitcoin and stocks continue to rally. It looks like it's going to be lower, but slower, but much slower. So what's going to be a factor in that? The Fed's still independent of the President of the United States. And Jerome Powell, I don't know if you guys, what did he say the other day in his presser? They asked him if he was open to like resigning, because Trump has basically already said he wants to replace him. But he's going to work for the Fed for, well over a year into the first year of the administration. So someone asked him if he was open to resign, and he just said, nope. Very short and simple. So it looks like Trump is going to have to work with Powell. But, what could change this? A rapid deterioration in the unemployment rate, or a big, uptick in inflation and prices, right? So as long as PCE stays under 3%, though, we expect the Fed to continue cutting like they have, but it's going to be at a much slower pace. So, this has unfortunately kind of been the mantra that we've been talking about. We're going to continue to grind on products. And Frank, thanks for, the product team works in capital markets, and they're all sitting right behind me right now. But yeah, there's no kind of refi boom on the near-term horizon coming to kind of bail out the mortgage market, right? Like it's going to continue to duke it out in the trenches for the foreseeable future, and that's sort of our path forward, is just keep making great decisions, keep building out technology that lowers the cost to originate a loan, keep expanding products into tools that are useful to consumers. Because I don't think rates are moving back to 4 anytime soon right now. So next slide. Okay, so this sort of gets to that question you had about LLPAs and the GSEs. So we can go to the next slide, but this is just, so what's the outlook for mortgages and housing? You guys would probably have a better look into housing than I do, but my general take from the election is, I'm glad that the president is going to focus on supply. I think that's where the issues are, and most people would agree. Cut red tape and unnecessary obstacles. But like I said, I'm a Floridian, and obviously my house is very hurricane proof and up to code. It's newer construction, so I'm really grateful for all that. Use federal lands to open up space for home construction. All those things I think are a net positive for housing. The question is, how do these federal lands that are probably mostly in rural areas, how do they actually impact the areas where people live, right? So I think that's the biggest thing. Like, I don't think there's a ton of federal land in the Chicago land area right here available for home building. So there's a lot of questions around that. I would also say on tariffs and deportations, right? Like that was a huge part of the president's campaign. Tariffs, how does that impact building supplies, imports? One of the traders was telling, and I didn't know this, but apparently we export all our lumber to China and then we import it back from them after it's been processed. I didn't know that. We'll have to maybe do some fact checking on that, but just things like that are present everywhere. Obviously, those are going to create some inflationary pressure. Deportations are very interesting. I have like a really hard time just thinking about how this is even possible, without creating some kind of humanitarian crisis. But it probably all starts with border security, and then some of these passports and asylum seeking, documentation and overhauling that is probably more likely. On either one of those topics, though, the president really can't move unilaterally on tariffs on a broad-based range of products or against a particular country. I think the president's powers are pretty much isolated to just SKU numbers on certain products, you know what I mean? So there's going to have to be a legislative effort on both of these things. And right now, the market's focused on deregulation and on taxes, right? That's where most of the lift is coming from. Let's skip forward. I think there were a couple of slides on this, but to me, this is really interesting, right? When it comes to affordability, like this is the problem. The interest rates, creeping into the sevens as of late, along with supply effectively being choked off. I mean, we've got the worst affordability in decades as a country. And, if you measure affordability by home price to sort of borrower income ratios, it just continues to go up and up. So yeah, I mean, this is what we're going to have to address, and hopefully interest rates are able to find some way to move lower. But I wouldn't count on that right now. Next slide. And then affordable housing, right? This, and I stole this slide from one of my colleagues at Chase, but when you look at the amount of regulation, like I've talked about, like that's tripled since the 1970s. At the same time, the amount of permits that have been issued for homes that are 1,400 square feet or less, which you could classify as affordable, that's dwindled down from about 35 to 40% of the permits issued to just over 5% right now. So that's another big story, right? Like, I don't know if marginally home builders, it's basically economical for them to make 1,400 square foot or less, but you can see there's a drastic decline in permits issued for 1,400 square foot or less homes. And obviously that's constraining affordability too.
I mean, that would make sense if if we're saying that it's costing builders 25% in regulations to build a house.
Right.
I mean, yeah. I would imagine building a 1,400 square foot house, whatever margins that they have are basically gone, or they're just having to increase their margins and have it be more expensive.
Yeah, exactly. The other thing, looking at the labor force in construction, I think something like 1/3 of all housing construction workers are foreign born. So it's just, for whatever reason, just not a very appealing profession for native born labor force. So how does deportation impact home building and the cost of a home and influence affordability when you're essentially removing 1/3 of the workforce potentially? I'm not saying that's going to happen. I struggle to envision it, like I said. But it's something to definitely think about, especially at a time where wages are outpacing home prices finally. So the economy is making some positive headway on affordability just through that, regardless of what interest rates do. So these are just kind of all challenges to pieces of the Trump agenda. So someone asked about the GSEs and the LPAs and everything that goes along with that. So if you rewind and look at the GSEs under Donald Trump's FHFA, I think the overwhelming priority was to end conservatorship and reintroduce Fannie Mae and Freddie Mac into the public as a publicly traded company, but essentially out of the government and out of the government's control. I think obviously there would always need to be some sort of implicit guarantee or oversight by the federal government, but that was the goal. So how did they do that? They made a number of changes under the Trump administration designed to do that. Like any company that is aspiring to be a publicly traded company, it really started with risk management, internal policies, procedures, getting back to profitability, and really getting rid of some of those business that just posed risk to Fannie and Freddie's balance sheet. So the biggest piece of that, I would say, would be kind of limiting exposure to the larger non-bank lenders in the country. So Rate, for example, we're one of the top 2 retail mortgage lenders in the country. GRA is way up there as well. We have to issue mortgage-backed securities. We used to be able to just sell loans directly to Fannie and Freddie. Now we do all mortgage-backed securities when we deliver product into the secondary market. So that was part of the Trump plans for de-risking. Basically move that risk to us, move it to bond investors, get Fannie and Freddie out of it. The other thing that they did was limit the concentrations of non-owner occupied loans, right? So I think the thesis was the taxpayer shouldn't be on the hook for financing someone's vacation homes or investment properties, right? The good news is the non-agency markets exploded with new business and non-QM around non-owner occupied mortgages. And I think the capital markets took care of that rather nicely, which is what the Trump administration wanted to do. Credit risk transfer trades also really picked up then. So if you think about what Fannie and Freddie are, and this may be the first time you're hearing this, but they're effectively like default insurers for mortgage-backed security holders, right? And what they do is they give companies like us, GRA, the ability to securitize mortgages and sell it to investors all over the world. And they do that fundamentally by stripping a mortgage into basically two assets, right? So there's one that's just the cash flows, principal and interest monthly, securitized into a product that even Frank Chardelli can invest in if he wanted to. And then they separate another asset out called the servicing rights, right? So Frank, if you wanted to, like, as an example, invest in conforming residential mortgages, you could buy a mortgage-backed security. I don't think you can set up the ability to take payments and do servicing and manage escrows and all that from your living room, very efficiently, right? So that's what it does by separating the investment opportunity from the servicing responsibilities. It creates servicers who service all these bonds. The bonds can then be invested in all over the world by banks, money managers, hedge funds, pension funds, whatever. And that's where all the liquidity for markets come from. And what Fannie and Freddie do is they essentially guarantee that those bondholders who invested in the residential mortgage market in the United States they're not going to miss a principal and interest payment. And if they do, like if a borrower defaults, Fannie Mae basically, insures, because the servicer many times is actually on the hook for posting that principal and interest payment when the borrower misses. But Fannie ensures that money flows through to investors, right? So it's guaranteed. So they're basically a big insurance company. So what they've been doing is selling those insurance obligations to the capital markets as well. So that was part of the Trump administration, right? Shore up risk management policies, move risk to the private sector, and eventually spin them off of the government's balance sheet. Under the Biden administration, obviously they think completely differently about Fannie Mae and Freddie Mac. They want to keep that as part of the government and use Fannie and Freddie to create affordability, and specifically focus on things like down payment assistance. Kamala Harris was even proposing, I think it was like a $25,000 grant for first-time home buyers. So do stuff like that with Fannie and Freddie, which is, 180 from what Trump was doing. So there's obviously pros and cons to both, and I'm sure everybody has a wide range of opinions on that. But part of the LPA discussion was initially about reducing the pricing. We call them hits, like that's kind of our slang word for them, but reducing the pricing adjustments for first-time home buyers and people like that, and then subsidizing it with higher fees on what you would consider better credit, right? So higher credit scores and lower LTV, less likelihood to default. So that was the model, like cross-subsidizing risk with those cash flows. And then ironically, Fannie and Freddie, they use all of the extra fees from investment property and second home financing to pay for a lot of the affordable. So like right now, the whole cross-subsidization model is a little out of whack because you've had a different administration every 4 years kind of tinkering with everything, if that makes any sense. So what I think will happen is the GSEs will kind of revert back to the Trump mandate, although he hasn't talked about it in a campaign. This is stuff that we follow really closely because it impacts our relationship, our relationships in Washington, D.C. Some of his pundits like Larry Kudlow, Bill Ackman, Hank Paulson, and a lot of those guys have big investments in the funds that they manage in the GSE stock, have been kind of out talking about ways to, maybe replicate what the FDIC does with banks, where there's like this guarantee, but they could still push Fannie and Freddie out of conservatorship. So, I don't know exactly what'll happen, but I know somehow, that boat will get rocked a little bit over the next couple months.
I wanted to spend maybe the last few minutes, doing some Q&A, if you don't mind. And I think this is like perfect timing question. And by the way,
Sure.
Amazing questions. We have lots of them, but this one in particular, is there any correlation with the housing shortage and the percentage of homes owned by hedge funds, private equity firms, and endowments?
I think, yeah. In terms of what's available for home ownership, certainly. Yeah. Right after the financial crisis, the BlackRocks and Blackstones and Apollos of the world, spun up resi funds to invest in and what essentially was large portfolios of rental properties. So yeah, I think that's definitely creating a major impact for individuals who want to become homeowners. There's no doubt.
Yep. Okay, another question. Trump has talked about a reset with the HUD department. What are the markets anticipating HUD's role and the structure going forward?
Yeah, on that one, I don't know. That is probably something I would talk to our compliance people who cover HUD. I haven't heard anything specifically about that. And like I said, he hasn't even really, in any of his rallies or speeches or anything, Twitters, truths, I guess, is what Trump is on now. He hasn't really addressed even the GSEs. That's been all Kudlow and Paulson and Bill Ackerman. So I don't know, but that's a good question. I'll take it away.
Going into 2025, when can we expect housing price forecasts to start coming out?
What was it again? Do we expect what?
In 2025, when can we expect the housing price forecast to come out for next year?
Yeah, the markets are definitely developing an opinion about inflation right now, right? And I think that's on housing is just one of those gray areas at the moment. I think home prices can they have a runway right now to continue along at about a 5 to kind of 3 to 5% growth pace, but at the same time, how do tariffs impact new construction? How to, this idea of deportation? It's probably going to be at least a year until we get into that. So I think you gotta, you really gotta stick with the regime, kind of set of indicators that are available right now, just because there's so much uncertainty there. And honestly, that's probably a late 2025 thing, I would think, before we start to see the impact from any kind of deportation or change in the home construction workplace. But on the HUD thing, I don't know. I haven't heard anything about that at all. Home prices, I think steady growth in the 3 to 5% range.
Well, and every loan officer's favorite question: what are rates going to do in 2025?
Yeah, and man, people hate when I say this. I'm sorry, but I think you got a flavor for it already. I think
Yep.
I think the Fed continues to cut. I think, albeit at a slower pace, right? So if Fed funds is right around 5% now, it probably ends next year at 425, or sorry, 425 to 450 around there. I think the economy's super hot. Trump's inheriting a hot economy, just, with an affordability crisis is kind of like one of the takeaways here. I think there's room for mortgage rates to fall, but look, I don't see anything in a four handle for 2025. So you're probably seeing rates sort of range bound in the sixes, six to the high, sixes. So 6, 7, 8s to 7. That's where I see rates over the next, 12 months. 10-year yields probably dip back down, retest that 360 level from before the rate cut. But again, I think they're going to be range bound too. And by the way, last year I predicted at our trading desk holiday dinner that mortgage rates would end the year at 6 and 7/8, and everybody thought I was nuts, and that's exactly where we're at. So.
There you go. And then another question: what kind of sources, do you like to read to sort of give you some insight as to what's going on in the market?
Yeah, so we trade with Goldman, JP Morgan Chase, Bank of America, and fortunately, because we're a decent account with all of them, and we run a pretty big mortgage origination business. I have access to like Jamie Dimon's like right-hand chief investment officer. So those are my favorite sources, is just ping someone on Bloomberg. Hey, what do you think? Hey, you got time to chat? Just pick up the phone, or, go have beers and listen to what those are my favorite sources. So to me, there's no substitute for just like live communication with people and respect. In terms of like the media, that is just brutal. I read the Wall Street Journal. I like Rick Santelli, for the Chicago guy down on the pit. It seems like I followed him since I was a kid. And whatever comes across Bloomberg, but it's mostly kind of business partner internal research, and I do my best to take it and send it out to our loan officers and give them maybe a little different view than you would find online.
So as a employee of Guaranteed Rate Affinity and Guaranteed Rate companies in general, we are super fortunate to be able to have almost daily updates from Jeremy and his capital markets team. So our loan officers at GRA are really understanding of what is going on day to day, getting some insight from Jeremy and his capital markets team, for the next week or two ahead. And it really does strengthen our ability to really provide a very high level of insight and resources to our referral partners around the country. But I really wanted to we had amazing attendance on this call, and I really wanted to thank all of you for taking your time today. We will have this call recorded, and it will be up on our YouTube station on Guaranteed Rate Affinity's YouTube page. Jeremy, I really appreciate your time and your team's energy behind the scenes with putting this together. And really appreciate, again, everyone's questions and insights on this. We're all in the same business, all trying to figure this out. And the more knowledge that we all get by professionals that are actually doing the work, it really does sort of, it's a rising boat that's lifting all tides. So again, everyone, have a great rest of your day. I really appreciate it. Please reach out to your GRA loan officer. They would love to help you out, your borrowers, and have a great rest of your day, and hopefully a great New Year's, Thanksgiving, and Christmas and Hanukkah. And we'll see you on the next call. Thanks again.
Got your eyes on a home? You'll need the local home loan experts at Guaranteed Rate Affinity. We are a fintech mortgage company that streamlined the home buying process. Our loan officers have direct access to the best real estate agents, giving you a completely seamless home buying experience. Featuring the industry's most advanced tech platform and customized loan solutions, our local loan officers can help you at any time from anywhere. Our digital mortgage and power bid approval will get you pre-approved in minutes with a strong offer, even against all cash offers. You need speed to win in this market, and our same-day mortgage delivers, getting you approved in as little as 1 day. Getting you on track for the closing table in as fast as 10 days. Speaking of the closing table, our flash close options shorten the closing appointment from hours to minutes, or skip it altogether. It's your choice. We've made the home buying experience as fast, simple, and awesome as possible for countless others, and we'd love to help you next. Get pre-approved today with the experts at Guaranteed Rate Affinity, and let's get you home.